Have you ever wanted to peek inside the mind of an investing master before the whole world knew his name? Well, today, that's exactly what we're going to do. We're diving into a letter from a 29-year-old Warren Buffett written way back at the end of 1959. Now, this was a year that looked incredible on the surface, but it was hiding a very different reality. And what Buffett saw that so many others missed, well, it's a true masterclass.
So, let's set the scene. It's 1959. And if you looked at the most popular market measure, the Dow Jones Industrial Average, things were on fire. Including dividends, it shot up an incredible 19.9%. You'd think making money was like shooting fish in a barrel, right? But that big, shiny headline number, it wasn't telling the whole story. Not even close.
And this is where you see the disconnect. It's wild. Even though the Dow surged, if you look at the individual stocks in the New York Stock Exchange, more of them actually went down than went up. Just let that sink in for a second. The average was up, but the average stock was actually down. This created a massive illusion in the market.
So this brings us right to the core problem of that year, this powerful market illusion. You had a handful of big-name stocks pulling the whole average up, while the vast majority of companies were actually struggling. It created this really difficult, confusing environment, even for the seasoned professionals.
You know, this quote from the president of the biggest investment company in the country at the time just says it all. He's basically admitting, hey, we're trained to look for real value, but this market is running on pure hype, and honestly, we don't get it. That line about needing to adjust their space boots, it perfectly captures that feeling that the market had just become completely untethered from reality.
But while a lot of people were confused or, trying to figure out their space boots, a young Warren Buffett out in Omaha was playing a completely different game. He wasn't trying to adapt to this new era, he was rejecting it outright.
And look, this caution wasn't some new reaction to the weirdness of 1959. He makes it really clear in his letter that he'd been wary of high valuations for years. He was always focused on the underlying value of a business, not the market's ever-changing mood.
And this right here, this is the bedrock of his entire philosophy. What he's saying is, look, I am much happier missing out on some gains by being too careful than I am risking a permanent loss of my partner's money by chasing some hot new trend I don't believe in. For Buffett, avoiding the big, catastrophic mistake is absolutely everything.
Okay, so you'd probably think this over-conservative approach would lead to some pretty dull average returns, right? Especially in a year where the Dow rocketed up nearly 20%. In fact, that's what Buffett himself predicted. But what actually happened was something else entirely.
So the big question is, how does a strategy that's built on caution actually do when market enthusiasm is totally off the charts? The answer might just surprise you.
Just look at these numbers. Buffett's partnerships returned an average of almost 26%. He didn't just keep up with the booming Dow, he beat it by a full 6 percentage points. And what's even more telling, he absolutely crushed the big professional investment trusts. They were only putting up numbers between 5 and 9%. His caution didn't hold him back at all. It actually propelled him forward.
So, how on earth did he do it? How did he manage to generate these incredible returns while actively trying to avoid market risk? Well, the secret lies in how he structured his portfolio. He built what he called a strategy of insulation. His portfolio was basically broken down into two big buckets. First, a massive concentrated 35% bet on a single company. Then, the other 65% was in what he called undervalued securities and workouts. Think special situations like mergers. The key is that both of these parts were designed to succeed based on their own merits, not on the whims of the market.
Let's break down that huge 35% investment. First, he bought into the company at a huge discount to what its actual assets were worth. Then he became the biggest shareholder by a long shot, which gave him real influence. The other major owners were on his side. They agreed with his ideas. So you see, this wasn't some gamble on market sentiment. It was a carefully structured business deal with a super high probability of success.
And that other 65% of the portfolio? It followed the exact same logic. He was investing in situations that were, in his words, at least partially insulated from the behavior of the general market. Think about things like mergers, liquidations, or just stocks that were deeply undervalued. Their success depended on specific company events happening, not on whether the Dow went up or down on any given day.
And here's the real kicker. This is Buffett's own prediction for his strategy. He thought he'd do great when the market tanked and just kind of average when the market soared. But in 1959, one of the best bull markets of that whole era, his insulated value-first approach delivered absolutely superior results. It's just incredible.
So what can we really take away from this amazing letter, written over 60 years ago? Well, the truth is, the principles are just as powerful and just as relevant for all of us as investors today as they were back then.
It really boils down to this four-part framework. First, see the real market. Look past the headline numbers. Second, always prioritize protecting your capital. Fear losing money permanently way more than you fear missing out on some gains. Third, invest with a margin of safety. That just means buying things for less than they're truly worth. And finally, insulate yourself from market craziness by owning businesses, not just renting stock tickers.
And all of this leaves us with the very same question Buffett asked himself. In today's world of non-stop news, hype, and market chatter, it's the fundamental choice every single investor has to make. Which penalty are you more willing to accept? The one that comes from being cautious, or the one that comes from being wrong?